Hello and welcome to Principles of Accounting 2. I'm your host, Dr. B. It's the very first day here at UMGC in the fall 2021 semester, OL1. This course is primarily taught online. This is an online course. These sessions that we host each week are designed to help our students to better understand the content each week. My name is Dr. Brandon Schweitzer, and I am your professor for this semester. I am a full-time faculty member here at University of Maryland Global Campus. I have been teaching accounting for several years now. It's been about 10 years. Before my teaching life, I was a financial controller for over 15 years. I was in the president's suite. I was a CEO at one point. I have a wide range of experience in accounting, finance, and economics. My passion is in accounting, which is what brought me into teaching. One thing that brought me to University of Maryland Global Campus is the wonderful students that we have here from around the world. Vast majority of our students are in the military. So thank you to all of you who are serving, who have served, and who are in families that are serving. And that's why I'm here today. And again, the goal of these sessions are to help you to better understand the content each week and to help you in completing your weekly homework assignments, exams, so forth and so on. So hopefully you're all able to see my screen. I'm showing you the classroom homepage. Every day, every few days, once every few days, typically I'll have an announcement welcoming you to the week, talking about what's going on that week. I'll remind you that when things are due, those types of things. I might also post some real life stuff that's happening currently, just try to keep it fun, right? So please make sure that you log in regularly to check the classroom, especially the announcements. So let's start off with, today is the very first day. So as you're logging into the classroom and exploring, let's take a look at week one in the content. First part of the content is the overview. As my name, our section number, my cell phone number, my email address. Preferred method of contact, of course, is email. All of your emails go directly to my phone, and so I get a little quick to respond. So I'm always responding to emails. It's a habit. It's a bad habit, but I have that habit. So if you send me an email and it's like some ridiculous time, I'll probably respond. Okay. So please feel free to email me anytime you have a question, or if you want to set up office hours, please feel free to email me, and I'll be happy to do so. Like my cell phone, I might not answer your call if I don't recognize the number. That's just nature. So if you do call me, leave a voicemail, please, with your name, the section number, all of that good stuff. And if you ever want to, we could do a one-on-one Zoom session. If you really need help, you're stuck on something. I'm here for you. That's my job, is I'm here for you. Okay. Exploring the classroom. The first area, start here. So I recommend you start there. There's a nice welcome, tells you about the background of the course, successful tips on how to succeed in the course. They're really just tools, yeah. UMGC's approach to learning, faculty student charter, very good things to quickly glance through, yes. The second part of the classroom is the course project. As you read through the syllabus already, hopefully you'll notice that we have a course project. It's called the Securities Exchange Commission 10K project. And the idea behind this project is you will select a company that is either a manufacturer or a retailer. No service businesses, please. A manufacturer or a retailer from the Fortune 500 list. The company must have accounts receivable and inventory. You'll locate their 10K annual report using the sec.gov website. The reports are very long. Don't worry about reading the whole thing, but it's important that you understand how the company operates, understand the financial reports, and you'll be doing a bit more of a deep dive in this course on those financial statements. You will write a report, give a presentation on the company. This project, it basically is due in week 7, but you should be working on it a little bit each week. And the reason why I say that is the discussions in each week are aligned with the project. Okay. The discussions are designed to help you in the process of writing your reports and the presentation and those good things. There's some formatting and things like that. And we'll talk more about that as time goes forward. I'll give more clarification on the requirements for the project and so forth and so on. So please explore the course project requirements. Course resources, good information. I'll take your time as you go through them. There's 17 of them, but you don't have to read through everything. It's just kind of tools that we have there for you to help you be successful in writing and things like that. So each week, how's it laid out? Each week, you'll have your introduction with weekly learning outcomes, the topics that are covered in each week. There's typically a couple of discussions, a list of the weekly activities, the learning resources. The learning resources are designed to help you to better understand the concepts, the topics, and of course, they're designed to help you to be successful in completing the weekly homework assignments and the exams throughout the course. So as you explore the learning resources, they're in links in each week. You'll read their topic pages, right? They're not very long. So some of them are a little bit longer than others. They won't take you very long to read through, but it's definitely important that you do read through them, because you will find that the questions on your homework assignments are very much related to what you're reading each week. Yeah. So that's the learning resources. The homework. When you get down to the homework section, there are usually a couple of items in each week. There's a discussion. In this case, there's 2 discussions for this first week. There is an assignment or a quiz or an exam. And then there's a self-assessment. So my recommendation for success in this course is the following. Number 1, first thing you want to do is take care of any discussions and any written assignments. After you've done those things, read through, and hopefully you've done it as you are or after you have read through the learning topics. Before you begin the homework assignments, my recommendation is to take the self-assessment. The self-assessment questions are very much related to the weekly homework assignments. The self-assessment questions, you could try each question unlimited times, and it's really designed to help you. Yeah. So do the self-assessment first, then tackle the homework assignment. The homework assignments, as you open the homework assignments, it looks like this. Okay. They're not timed. Students, so good news with homework assignments. You can attempt homework up to 2 times. That's nice. Okay. If you don't like your score, or you can attempt it a second time. The nice thing is we take the highest of the two scores. Okay. Here's how it looks. Each homework assignment it's like 10 questions. Okay, about 10 questions. Some are a little bit longer, some are a little bit shorter. Most, on average, about 10 questions per homework assignment. There's a homework assignment in each week. They are, for the most part, multiple choice, some true, false, some matching, some direct answer. The direct answer, it's like they're math questions, right? But they're direct answer, very straightforward. And that's how the homework assignments are designed. Again, you get 2 attempts. So if you're not satisfied with your grade on the first attempt, please take it again. That can only help you. The other reason why we have 2 attempts on homework is very simple. Accounting is a practice. It is best for you to continually practice in order to best learn the content. You don't learn by just reading and then taking a test. Retake a test, retake a test. You don't learn that way. No one learns that way. The only way you remember things is by practicing. Okay. So my recommendation, take the homework twice, become more familiarized, run through a couple of examples. In my lectures, I have examples. In the text, there's some examples. In the self-assessment, that's more practice. So please practice, 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 practice. That's how we get good at accounting. Yes.
Professor B, could I ask a quick question on the self-assessment?
Yes, please.
So on my former self-assessments for other courses, I don't know if it was just a system glitch or not, but I actually never got whether my answer was correct or not. Do your self-assessments at least tell you if you got the answer correct, even though it's not graded?
Yes, they should be.
Okay.
It's, as far as I am aware, they should. Yes. Well, they should be. I'll get with IT. I'll get with IT to find out what's going on there.
Yeah, I had a course last semester where the self-assessments didn't actually tell you whether you got the answer right or wrong. I mean, I did fine in them, but I don't know if it was a glitch. And then
yeah, there very well could be. Yeah.
Yeah, my second question. So in my statistics class, with the general entries without multiple choice, there was a formatting concern. Do your quizzes and exams outline a specific format? And if you by chance enter in the incorrect format, will you look through them to potentially give a partial credit?
Yes, 100%. Yes to both your questions. So the format is relatively specific. It'll designate round up or no cents, right? So that means there's no decimal and cents involved in the answer. So to answer your question, yes, it's very specific. Enter as a whole number, it'll say.
Great.
So yeah, it'll be very specific as to the format.
All right, thank you very much.
You're very welcome. Excellent questions. And that's how each week is designed. The exams are very similar in nature to the homework. So what do I mean by that? It's the same type of format. They're just longer, right? That's the idea of an exam. The exams are relatively comprehensive. So the first exam is not until week 3. In week 3, when you take exam 1 covers weeks 1, 2, and 3. Okay, weeks 1, 2, and 3 are covered in exam 1, so they're comprehensive in that nature. And I'll remind you of that as we get closer to that exam. So each week, very similar layout. My strong recommendation, if you haven't done it already, please select a company. It can't be the same company that another classmate has selected. I recommend you do that early because the company you like might get snatched up, right? So, and I need to approve your company selection. So that's why it's important that you complete that week 1 discussion, request a corporation as soon as you can. Okay, let's go ahead and jump into the content. So this week, we are talking about owner's equity and a little bit about long-term liabilities. So what is owner's equity? Owner's equity is what the owners own in the business. Yeah, it's a little bit more complicated than that, but that's the general basis of owner's equity. Long-term liabilities. Long-term liabilities. Liabilities, as you know, is anything that the company owes to someone else. That's a liability, right? I I haven't paid my electric bill yet. That is a liability to me. Uh, I haven't paid my employees yet. That's a liability to me, the company. I owe a payment on whatever piece of machinery. That's a liability to me. So anything that the company owes is a liability. Long-term liabilities is simply means anything that the company owes to someone else greater than 1 year. Greater than 1 year. Okay, so let's talk a little bit more about owner's equity, which is the focus of today's session. Equity, as I had mentioned, is what the owners of the company own, right? Owners of the company own. You heard me say owners. Yes, there can be more than one owner, of course, especially when we talk about publicly traded companies, even private companies that have multiple shareholders. There are forms of ownership. The forms of ownership have to do with how we represent ownership within the company. This can either be done by percentages of ownership, or it can be done through stock, or through some other form of representing the amount that someone in the company owns. The most common form of ownership is through stock ownership. Stock simply means a portion that an individual that owns a company owns, like a percentage, essentially. And we'll break that down a lot further. So there's two main sources for owner's equity. There's this thing called paid-in capital and retained earnings. Paid-in capital is when there is an investment of capital, cash, right, into the business from the owners. So when I start a business, if I'm looking to start a business, or if I already own a business and I need to inject cash into that business, I might take it out of my personal account and invest into my own company. That's called paid-in capital. It's capital directly contributed to the company from the owners. Okay, that's paid-in capital. And retained earnings. Hopefully you remember what retained earnings is from Principles 1. Retained earnings is the money retained in the business. Retained. The word retained means kept in the business. Retained earnings. Retained earnings gets generated at the end of each accounting year based on the revenues minus expenses minus that goes to net income. Net income minus any dividends paid equals retained earnings. Retained earnings is the way to think about it. That's the profit left in the business to be invested in the business, right? That's the idea behind it. And this, so let's talk a little bit more about paid-in capital, since this is probably a newer concept for most of you. Paid-in capital is the money invested into the business from the owners, as I had said earlier. One of the primary sources of paid-in capital is from the issuance of stock. So if I invest into the business, if I'm putting cash in the business, I expect to get something back as an owner. And what I get back is called stock. It represents my shares of ownership. So let's talk a little bit more about stock so we can better understand how stock works. The idea of stock is that it is a form of ownership that is authorized, issued by the company. Okay. Uh, when you hear the word authorized, it means that the company said we have the legal authority based on our company charter to issue X number of stocks to the general public or to the owners, right? When a stock is given out to an individual, we call it issued. For when you hear the word outstanding stock, the word outstanding means it is outside of the business. Outstanding. It's outside the business. It means that I have issued X number of stock. That number of stock is outstanding. It is held by individuals. So the number of shares held by individuals is called outstanding stock. A couple quick definitions. Here's a nice graphical representation of that. Now, you'll notice with this, typically a company will authorize more shares of stock than have been issued or have been outstanding. So I might authorize 1 million shares of stock. I might issue 500,000 shares of stock. And out of that 500,000 that is available to the public may have acquired, which is outstanding to the company, 300,000 shares of stock. And that's very, very common. A quick point of note, this question, this will be one of your questions. Par value. This is going to be on your homework assignment. Par value is a very important term to understand. Par value. Shares of stock are assigned a dollar amount. That's the value of stock. We call that par value. Par value. It's the value of the individual share of stock. Par value. Sometimes a stock will be issued without par value assigned to it. In other words, it will be issued without a value assigned. We call it non-par stock. It's rare, but in some states it's allowed. And typically non-par value stock is issued to board of directors or employees of the company. And the reason why some companies will issue non-par stock to the board of directors or employees of the company is to provide them with a benefit of ownership. And sometimes that non-par stock will be assigned a value in the future. Okay, also important to note that most states require corporations to hold a minimum amount of paid-in capital. Typically, that amount is reserved within the company for legal reasons to cover the value of shares issued. Covers the shareholders, basically. Okay. What are the rights of the company ownership? Most individuals have the right to vote in matters concerning the corporation when you hold shares of stock. You have the right to a share of distribution of earnings. In other words, you have the right to distributions. And you also have the right to liquidation of assets upon the company's liquidation. What does all that mean? I own shares of Starbucks stock. Okay. If Starbucks has they are electing a new board of directors, I have the right to vote on that board of directors. Although my vote will be very small because I have a very small amount of stock. I also have the right to receive a dividend for each share of Starbucks stock that I own. So I might get 50 cents per share of stock that I have if the company declares a dividend payment. We'll talk more about that here in the future slides. And if the company goes out of business, or they decide to close up, retire, whatever, upon the liquidation of the company, I have a rights to the assets. Although, again, it'll be very minimal. Let's talk about the different kinds of stock. There are two primary types of stock. One is called common stock, and the other one is called preferred stock. Common stock is the type of stock that is most commonly issued, hence its name, common stock. There's a lot more common stock than there are preferred stock, typically. Sometimes a company will have more than one type of stock. And when that happens, the other type of stock is called preferred stock. Preferred stock. And with preferred stock, there's typically a dividend that's associated with the performance of the business. When you're doing your research and you're selecting your companies for your 10K projects, when you get down to the owner's equity portion on the balance sheet, you might see common stock. You should actually see common stock. And you might also see preferred stock. In that case, it's important to understand that preferred stock is tied to dividends. So if you see preferred stock, there's more than likely going to be a dividend line item on the shareholders statement of shareholders equity. So here's an example of preferred stock. Dividend rights of preferred stock are stated either as per share or as a percent of par. What does that mean? So for every, in this example, $4 stock, $50 par. What does that mean? For every share that is worth $50, I have a dividend preference of $4 per share. Okay. You could also say for every $50 share that I have a preferred dividend of 8% per share. And basically what this is saying is I have a preference, the word preferred stock, I have a preference to receive a dividend for each share that I own. And it's represented as either a dollar amount or a percentage of each share of stock amount. And all of that is expressed, it'll be given to you. All of that data will be given to you because when the company declares a dividend, they must specify the dollar amount of that dividend per share of stock. Preferred stockholders have the first right to any dividends, and then the common stockholders get the rest. Again, the word preferred, right? I prefer the dividend, preferred stock. So just good to know. So when there's a dividend available, preferred stockholders in the front of the line, the common stockholders are in the back, right? That's the whole idea behind it. And we'll get more into premiums and discounts and things like that when we talk more about the stocks. So when a dividend is authorized, it's done by the board of directors. The board of directors will, when they authorize a dividend, it's called a declared dividend. Cumulative preferred stock have the right to receive dividends that were not yet declared in prior years. What does this mean? Let's say that Starbucks has not issued any dividends in the past 5 years. Okay. Then all of a sudden, they decide, hey, you know what? Let's issue a dividend this year. Great, wonderful, awesome. What happens there is, as a preferred stockholder, not only would I receive the dividend for this year, I would also receive the dividends that they did not pay out in the previous years. That's why it's called cumulative preferred stock. It's in arrears. Hopefully you heard the word in arrears. It means it's amounted up and it hasn't been paid out yet. Yeah. Here's an example. I like examples. Corporation issued 1,000 shares of cumulative preferred stock at a dividend of $4 per stock. It's valued at $50 per share. $50 par. That's what that means. And the company also issued 4,000 shares of common stock at $15 per share. Company was organized as of January 1st and paid no dividends for 3 years. 01, 02, 03, or 11, 12, 13, whatever. The corporation paid $22,000 in dividends, of which $12,000 were paid to preferred shareholders and $10,000 was paid to common shareholders. Here's how we find out how much is paid out, okay? Now, you saw the word cumulative. Cumulative, again, means it's accumulated over the series of years that have not been paid out. For the preferred stockholders, in 2011, dividends, they declared 1,000 shares, right? How do we get 1,000 shares? You might be, yep, they declared 1,000 shares. 1,000 shares at $4 per share. In 2011, 4,000. 1,000 times 4 for 2012, 4,000. 1,000 times 4 for 2013, 4,000. You add all those up, it's $12,000 for the 3 years. Remember, it's cumulative. We paid a total amount of dividends of $22,000. 22,000 minus the 12,000 means the common shareholders received 10,000. So to find how much common shareholders got, we simply subtract out the preferred cumulative preferred stock. So preferred stockholders, if we look, the preferred stockholders ended up receiving $12 per share. Why is that? Well, if we look at it this way, the preferred stockholders received $12 per share because they should have received $4 in 2011, $4 in 2012, $4 2013. That's why they received $12 per share. 12,000 divided by 1,000 shares issued. Common stock received $2.50 per share. How do we figure that? The total amount paid out to the common stockholders was 10,000 divided by 4,000 shares. That gets you to your cost per your price per share, cost per share. Cost per share is pretty simple. You take the amount of dividends divided by the number of shares issued per class of stock. In the event the business is liquidated, first creditors are satisfied, and then the preferred shareholders, and then the common shareholders. We're not going to get too deep into that in this course. Issuance of stock. The first thing the company does is they record the amount each class of stock is issued. The second thing they do, and it looks like this. This is the journal entry. So step one, when issuing stock, record the amount for each class of stock issued, preferred stock, common stock. In our example, Our company authorized 10,000 shares of $100 of preferred stock and 100,000 shares of $20 for common stock. Company issued 5,000 shares preferred and 50,000 shares at par for cash. Okay. What does all this mean? When a company issues stock, the idea behind it is that the company is raising capital. Okay. If you hear, oh, X, this company X, Starbucks, whatever, issued 100,000 shares. But what does that mean? That means the company is raising cash because they're selling stock. They're issuing stock. They're selling it to the public. The idea behind this is that the company raises money, raises capital. So, as you know, when the cash increases, we debit cash. Cash increases, we debit cash. Yeah. So, in this case, we debit cash 1.5 million. We credit preferred stock 500,000, credit common stock 1 million. The reason why we credit stock is because, as you know, stock is equity on the other side of the balance sheet. Cash is an asset. Stock is equity. Cash to increase an asset, we debit the asset. To increase equity, we credit equity. Yeah, and that's why when we issue stock, we credit stock. Now, a couple of nuances when we issue stock. Sometimes stock is issued by a corporation at a different price other than par. Remember, par is the, we'll call it the market price, okay? Par is like the market price. It's the price per share. It's the market rate. It's par. And sometimes the company will issue a stock price either above par, at par, or below par. And the terms we'll talk about are premium and discount. And the reason why sometimes the company will issue stock at a premium or a discount is based off of a couple of things: financial conditions, earnings records, investor expectations, general business economic conditions, so forth and so on. When stock is issued at a premium, it is issued at a price that is higher than par. Above par, premium. It's like selling a product above the market price. When you sell something above market price, you're selling it at a premium, right? We're seeing that now with a lot of things: houses, used cars. They're being sold at premiums above market value. Why is that? Demand's crazy high. There's other market factors, right? More expendable cash, so forth and so on. Stock works the same way. When stock is sold above par, market price, it's sold at a premium. When stock is issued lower than par, we call it issued at a discount. Okay. And we track this through journal entries, as you might imagine, and we issue these to the public at large, rather than just selling them to an investment bank or transferring to an agent or registrar. The idea behind it is, if I sell something at a premium, there's a reason for that. I am increasing investor expectations. I am increasing the value of the par. If I issue a stock at a discount, typically the reason I'm doing that is because I'm raising capital. I might be in financial straits, tough times. Yeah. So I might sell this share of stock lower than its value just to get the cash flow, right? That's why companies do things like that. When we sell at a premium, obviously we debit cash or increasing cash. We credit common or preferred stock, whichever it is. And we also credit paid in capital in excess of par. Paid in capital in excess of par. It's very similar to a lot of journal entries you probably made in accounting 220 or principles 1, is when there's a difference between your debit and your credit, your primary accounts, there's typically an adjustment account. Think of the paid in capital in excess as your adjustment account. Yeah. And we credit that, of course. Here's how that looks. So our company issued 2,000 shares of preferred stock at $50 per share. We issued that at $55 per share. So $5 above each share that we issued. That's 110,000. How did we calculate 110,000? You might be asking. 2,000 times $55 is 110. Okay, so 2,000 times 55, 110,000. So debit cash, 110,000 to increase your cash. We credit preferred stock of 100,000. I hear you already. Dr. B went out 110. Well, the value, the par of the preferred stock is $50 a share. So $50 a share, par value, preferred stock, 50 times 2,000, 100,000. The difference is 10,000. How we got 10,000? You can calculate that one pretty easily. Yeah, you can either do cash minus the amount of preferred stock at par value, or you can simply go 55 minus 50 is $5. $5 times 2,000 is 10,000. It's more than one way to calculate it, right? So the idea behind issuing a premium on the stock, typically when the stock is issued, it's in exchange for an asset. Sometimes it might be issued in exchange for an asset other than cash. What do we mean by that? You may have heard, I want to use that as an example. I'm trying to think of a good example here. Let's say that your company is trying to raise capital, but the reason why they're raising capital is to purchase a building. Okay. So what the company might do is they might make a deal with the building owner. Say, hey, building owner, I will give you X amount of cash plus a percent of ownership, X number of shares at a premium per share. That's the idea behind it. It's to provide them with that benefit to acquire another asset. And instead of just using all cash, they might do cash plus percent of ownership through shares. Right? And that's just one of many examples of why you might do premium on a stock. So looking at in this example, our company is purchasing land. So in the purchase of that land, instead of giving the landowner cash, I might say, hey, you know what? I'll give you a premium on the company stock, which is sometimes, in most cases, even worth more than cash. So we gave the landowner 10,000 shares of our stock. At the time, the par value was $10 per share. we gave the landowner a premium of $12 per share. $12 times 10,000 shares is 120,000. So we debit land because we're purchasing land in exchange for common stock, 120,000. We credit common stock, 100,000. Why 100,000? That's the par value. 10 times 10 is 100,000. And the difference is 20,000. How we got 20,000? You might be asking. $12 minus $10 equals $2 times 10,000 shares. 2 times 10,000 is 20,000. So anytime that the question is asking you, what is the paid-in capital in excess? There's a few ways to find that answer, right? We can either subtract the premium from the par value and multiply that by the number of shares, or we can take the debit amount minus the common stock amount. Either way, you'll get to the same answer, whichever is easier for you. Non-par stock. Earlier, I had mentioned that in some cases, there might be an exchange for paid-in capital for non-par stock. Non-par stock is typically reserved for the board of directors or other managers of the company. And sometimes they will issue, sometimes it's a part of a package, a benefit package, or a separation package. So let's say you worked for a company for X number of years, the company is downsizing, they say, hey, listen, we'll give you this real nice package if you retire early. The package includes stock, non-par stock. And what that allows is you can sell the stock at the market rate. That's one of the reasons why they do non-par stock. Another reason is because the company wants that initial paid-in capital. Here's an example. January 9th, our company issued 10,000 shares of non-par stock, $40 per share. On the 27th, we issued an additional 1,000 shares at $36 per share. We record the two entries. Obviously, they're two separate entries because they're two separate events. You know that every time we make a journal entry, it's its own event. Therefore, it deserves its own journal entry. So January 9th, we issued 10,000 shares, $40 per share. Debit cash, 400,000. Credit common stock. Very straightforward. There's no funny business. There's no in excess. There's no undervalue. There's no excess. There's no less. 400,000, 400,000. Very simple. $40 times number of shares issued at non-par. We had a second instance of the same, $36,000, 1,000 shares at $36 per share. That's $36,000. Debit cash, credit common stock. Remember, debit cash to increase cash. Credit common stock to increase common stock. Common stock is an equity account. Cash is an asset. Some states require a stated value per share. Actually, most states do these days. What does that mean? Even though I issued 10,000 shares of non-par value common stock, I still need to attach a value. So I said that it's at $40 per share. Because remember, non-par, the word par means I'm attaching a value to each share of stock. Non-par means I'm not attaching a value to each share of stock, although that share of stock is still worth something. So the company still attaches a dollar amount to those non-par shares of stock. So in most cases, companies require that the company, most states require the company attaches a value, a par value. And so they would have to do what they've done before by debiting cash, crediting paid-in capital in excess, and crediting common stock. Here's an example of that. So, so we had the earlier examples, 400,000, 400,000, 36,000, 36,000. Now the state comes to us and says, hey, you can't do that. When you sell shares of stock, you need to attach the value. So, okay. So here's how it works. We issue 10,000 shares, $40 per share, and an additional 1,000 shares at $36 per share. That part hasn't changed. The non-par common stock has an assigned value. In other words, the state says, hey, you have to give that a par, right? Although it's still non-par, it has a stated value. The stated value is the difference. So we still debit cash 400,000. We credit common stock 250,000 instead of the full 400. Reason being is because we have to attach a value. And that value becomes the paid-in capital in excess. So how do we answer this question, you might be asking? Well, let's break it down. The stated value, $25. We issued 10,000 shares. 10,000, 25, 250,000. Okay, so paid in the common stock, 250,000. It's the stated value times number of shares issued. The difference gets the paid-in capital in excess of the stated value. 400,000 minus the 250,000 equals 150. That's how we find the paid-in capital in excess. When you see in excess or you see loss of whatever, we always know that that's the difference. And the difference, we can simply calculate it by taking our cash minus common stock. That's the easiest way to find it. And we would do the same thing with that second journal entry. So that's stock. We're okay with stock. Do we kind of have a basic understanding? Any questions so far? Did I bore you all yet?
No, this was great.
Wonderful.
Michelle, what's the benefit in doing non-par versus par? Is it the stated value?
Yeah, exactly, Michelle. So the reason why my company might issue non-par stock is it's an incentive, and because non-par stock is typically issued only to board of directors or other employees of the company. And that incentive basically it's kind of like a bonus or a way to get the employee to stay in the company, or get the company to leave, or to get the company to invest, right? Or the employee to invest. Typically, it's a way to get the board of directors to invest in the company. And so the non-par stock typically is issued at a lower value other than the par. And what that does is it allows for the company to raise capital from its board of directors, gives the board of directors buy-in. When the board of directors retires, they part with the company, they can sell their share of stock. And that will be their benefit. So that's the primary reason why they issue it. And so anytime that but as I had mentioned, in some states, most states, the state law requires that when there to be an attached value to that stock. And so the company will typically select a lesser value than what this stock is, the par is. And that's really the whole concept behind issuing non-par stock. Does that help to explain the concept?
It does. Thank you.
Hey, my pleasure. Dividends. Let's talk about dividends. I love dividends. Oh, dividends. So nice to get a small check in the mail every so often. Very small check. Dividends. When a board of directors votes to declare a dividend, it is authorizing the distribution of cash to stockholders. This happens when the company does real well. Okay. A company should not be paying dividends if they're struggling. Okay. A company doing real well. Let's say it's Starbucks. What can I tell you? I'm addicted to coffee and I like Starbucks. Okay. Let's say it's Starbucks. They say, hey, we're going to issue our shareholders a dividend. Great. Wonderful. Awesome. Dividend is 50 cents per share. Okay. So what happens? The board of directors gets together. They take a vote to authorize a dividend. It's a distribution of cash to the stockholders. That's what a dividend is. When they authorize it, it's often called declaring a dividend. But declaring dividend and paying a dividend is two different things. We'll talk about that. In both cases, the dividend reduces retained earnings. So here's how it works. As you know, all companies start with your income statement. Revenue minus cost of goods sold equals gross profit minus expenses equals net income. Net income goes to your retained earnings. Okay. Retained earnings minus dividends gives you the ending balance retained earnings. Okay. The idea behind, and you'll find that on the statement of retained earnings. Yeah. So the idea behind it is that dividends is a way of providing that benefit of ownership to stockholders, and it should only be paid when the company is doing well. So company's doing well, it means there's sufficient amount in retained earnings. The company has enough cash to pay the dividends, and there's formal action taken by the board of directors to declare and issue the dividend. When the dividends are issued, okay, when the dividends are issued, debiting retained earnings, crediting cash. Yeah, dividend expense. That's the idea behind paying the dividend. When again, so only happen when there's sufficient retained earnings. Sometimes a company, when there's really high profits, company's doing extremely well for whatever reason, the board of directors might very rarely issue an extra dividend or a special dividend. That's nice when that happens. To declare a dividend, there's a date of declaration, date of record, and a date of payment. Date of declaration, that's when the board of directors authorizes the payment of the dividend. That's also when we record the liability of the dividend. Now, as you know, anytime that we affect our accounting equation, assets equals liabilities plus equity, our accounting equation. Anytime we affect the accounting equation, there are two or more accounts impacted. That's double entry accounting. Hopefully you all remember this concept. When we record, and I'll show you what the record looks like. But of course, as you would expect, we're increasing a liability when on the date of the declaration. So we're going to debit our dividend expense. We're going to credit our dividend payable, so on and so on. We'll talk about it. So during the time, we record the dates, of course. The date of the payment It's very important to know. It's basically 2 journal entries. Okay, I'll show you what those journal entries look like here in a second, but let me show you how we calculate the dividend per share. Dividend per share is very straightforward. Okay, we have a par value, and we have number of shares outstanding per class, preferred class, common class. The dividend per share for the preferred stock is oftentimes different than the dividend per share for common stock. In this case, we got $2.50 per share of common stock for the dividend and 30 cents per share of common stock for the dividend. How do we find these amounts, or how do we calculate this total? Okay, here's how it works. $2.50 per share, 5 times 5,000, 12,500. Oh, I'm sorry. Yeah. 30 cents per share declared, 10,000 shares outstanding. That's a total of 30,000 that gets paid out. Total dividends paid out in this declaration of 42,500. Now, here's the expense and the payable. So the first transaction is we got to increase our dividends expense. In this case, the account name is cash dividends. It's an expense account. Debit, cash dividends, 42,500. Credit, cash dividends payable, 42,500. That's at the time the declaration is made. Then, as you know, with any payable, we need to pay it eventually. So when we go to actually make the payment, we debit cash dividends payable to reduce the payable, and we credit cash to reduce our cash. That's with a cash dividend. Now, with dividends, it doesn't always have to be in the form of cash. Okay, what do I mean by that? Sometimes the company might say, you know what, we don't have a whole lot of cash to go around this year, but we do have extra shares of stock. So instead of issuing cash as the dividend payment, stockholders can receive additional shares of stock through what we call a stock dividend. And it's normally for common shareholders only, not preferred shareholders. Because remember, preferred shareholders are typically board of directors, so on and so on. Common shareholders, everyone else, can receive additional stock as a form of a dividend. That's kind of nice because basically the way it works is, let's say I have 2 shares of Starbucks stock, and Starbucks decides to issue a stock dividend. And that stock dividend is an additional share of stock rather than a $2.50 dividend payment. That's kind of cool because you have that additional share of stock, and that value of stock is at the fair market. So as the market value of that stock increases, so does that stock price, which is very nice. So when you go to sell that share of stock, you get the market value. That's kind of the idea behind it. And it works. The reason why a lot of companies like to do this is because it attracts new investors. It attracts new stockholders. It's a nice carrot. It gets people involved in the market or in that company. So here's an example. Company issued 2 million shares of stock at $20 par value. So that's $400 million. Paid in capital in excess of par is 9 million. Retained earnings 26,600,000. Okay, how do we get there? Let's take a look. We declared a stock dividend of 5% or 100,000 shares. 2 million times 5% is 100,000 shares. We're issuing this on January 10, based off the record from December 31st. And the market price per share is currently $31 per share. So here's how it works. We debit stock dividends, 3.1 million. We credit the stock dividends distributable, 2 million, and we credit paid-in capital in excess, 1.1 million. The idea behind this is when the company issues additional stock as a benefit instead of a dividend, this is typically done in excess of the par value of the stock, and so that's why it's shown this way. Don't worry, we don't go too deep in this class, especially for stock dividends. That's that's more for like an investing class. But the reason why I'm showing you all this is because it reinforces the concept of the journal entries, and it reinforces the concept of computing paid-in capital in excess, and computing the amount of dividends paid, that type of stuff. Again, accounting is a practice, so practice. That's why we go through so many examples. Okay, so at the end of the accounting period, stock dividends are closed out to retained earnings. As you know, in the closing process of accounting, which hopefully you remember the closing process from 220. At the end of the accounting cycle, at the end of the year, we need to close all of our temporary accounts from our income statement to retained earnings. And through that process, we are also closing out our dividends paid out throughout the year, dividends account, dividends expense, retained earnings. And so those get closed to stock dividends distributable and paid in capital in excess when that exists. And that all shows up under on the balance sheet under equity. So this when there was the issuance of the stock dividend, we debit stock dividend distributable. Distributable is basically like payable. It works the same way. It's a liability account. And we credit common stock. Doesn't change assets or liabilities since it's components of equity. Okay, last example. We have a stockholder who owns 1,000 shares, we have one stockholder who owns 1,000 shares of a company's stock. And the company has a total of 10,000 shares outstanding. That means one person has 1,000 shares out of 10,000 total. If the company declares a 6% stock dividend, that means that one shareholder will receive an additional 60 shares. How do we figure this out? We got one person who has 1,000 shares out of a total of 10,000. Okay. If the company declares 6% dividend, meaning we're going to give everyone 6% additional shares, we can compute that. 10,000 shares out times 6% is 600. So 10,000 plus 600 is 10,600 total. One person owns 1,000 shares. 1,000 times 6% is 60. 1,060 shares total. Percent of ownership. This one person owns 10% of the whole company. How do we figure that out? 1,000 shares divided by 10,000 total shares outstanding is 10%. And even after the stock dividend, this person still owns 10%. So the reason why I'm showing you this is to show you that regardless of whether the company is issuing a dividend in cash or a dividend in stock, the percentage of ownership does not change. So that one person who had 1,000 shares originally, they still have 10% of the company. So in my earlier example, when I said, I had 2 shares of Starbucks stock and they issued a stock dividend of 1 share. Now I have 3, but my percentage of ownership did not change. And it's very similar with stock splits. Stock splits work the same exact way as stock dividends. Now let's talk about treasury stock. Treasury stock is something that you will probably see on your 10K statements as you're selecting your company and you're doing your research. Treasury stock. This happens when the company repurchases its own stock outstanding. So let's say that I own 3 shares of Starbucks stock, and the company comes to me and says, "Hey, Dr. B, I want to purchase 1 share of stock back from you." It's great. Pay me for it. So, and they'll pay you, they typically pay you a premium to repurchase that share of stock. When a company repurchases its own stock, in other words, I'm taking the stock out of the market and bringing it back into the company, that's called treasury stock. I'm buying back my own stock. There's a couple of reasons why companies do this. The most common reason is because the company is raising the value of the company, raising the value of the individual stocks. That's to, of course, attract more investors, attract new investors. The stock price goes up. Okay. When there's less of something in the marketplace, the price goes up. That's the idea. Company is purchasing back their own stock. There's a reason why they do it. Usually it's to raise the price of the stock, make the company more value. Other reasons would include reselling those shares of stock to their employees, issuing as bonuses to employees. These are other reasons for it. With treasury stock, we use the cost method to record the purchase and resale of the treasury stock. We debit treasury stock when we purchase treasury stock, and we credit cash to reduce our cash. And we also debit or credit paid-in capital. The paid-in capital from sale of treasury stock. The reason why it's a debit or a credit is because oftentimes when the treasury stock is purchased by the company, there will be a difference between the price that's paid and the par value of the stock. So let's work through an example. Common stock, $25 per par value. There are 20,000 shares authorized and issued. That's 500,000. 20,000 times $25 is 500,000. In excess, over par, 150,000, giving us a total of 650,000. Here's how it works. The company purchased 1,000 shares of its own common stock at $45 per share. Okay, that's obviously well above par value. Then the company sold 60 shares of the treasury stock for $60 per share. and then sold the remaining 400 shares of stock for $40 per share. To represent the original purchase of treasury stock, we debit treasury stock to increase treasury stock, and we credit cash to reduce our cash. The second transaction is we are selling our treasury stock to new shareholders. We debit cash to increase our cash. We credit treasury stock, and we credit paid-in capital from the sale of treasury stock. What that shows us is we are selling those shares of stock above the par value. Then we have a second transaction. We sold an additional 400 shares at $40 per stock. Now you see, we debited cash, and we also debited paid-in capital from the share of treasury stock. Reason why we debited it that is because it was sold at a lower value. We credit treasury stock. So that's an interesting concept to understand. Now, when you see paid-in capital is it from the sale of something. Doesn't have to be treasury stock, from the sale of anything really. Paid-in capital. It's the difference. It's the difference. So when you have a difference between the cash you received or the cash that went out and the stock, then we know that there's paid-in capital involved. That's always the difference. On October 4th, there was a decrease by $2,000 because there was a credit balance of $9,000, which is the difference. It's a long way of going around it. No dividends or cash are paid when on the shares of treasury stock, because that would affect retained earnings. On the balance sheet, this part gets a little bit more important. On the balance sheet, let's look at the balance sheet. As you know, the balance sheet includes a list of accounts for assets, liabilities, and equity. Assets equals liabilities plus equity. That is the accounting equation. That is the balance sheet. Under equity, there are two methods that companies use to record the stock. Okay. First method is that each class of stock is reported. You have common stock, preferred stock, listed out. They're listed out. And it's based off a deduction from the treasury stock. Second method is the stock accounts are reported and then followed by paid-in capital. So method one, you have common stock, preferred stock, just listed out. Method two, you have common stock, preferred stock, and then paid-in capital. It's just basically shows the breakout, right? We can see in method one that we didn't break out paid-in capital. It shows through in retained earnings. Retained earnings, okay? Retained earnings. With retained earnings, all of the changes happen through retained earnings. Method one. Method two, retained earnings listed on the balance sheet. Or I'm sorry, the paid-in capital is listed as its own line item on the balance sheet. That's the idea. That's what I'm trying to show you here. It's just two different methods of reporting it on the balance sheet. That's why it's good to at least understand that there are two different ways of reporting it on the balance sheet, especially when there's treasury stock involved. And these will also be represented on the statement of stockholders' equity, and oftentimes in the notes to the financial statements. Those notes are so important to read on the 10K report. So important to read the notes because the notes tell you a lot about the information behind the numbers. Yeah. Changes in retained earnings are reported on separate retained earnings statement on the combined on the income and retained earnings statement and the statement of stockholders' equity. Separate retained earnings statements are prepared. You'll see that. So when you read through your 10K report for your company that you selected, you'll see income statement, balance sheet, statement of cash flows, statement of retained earnings. Statement of retained earnings includes all of these transactions that happen throughout the year with respect to the various stock transactions. And here's how that looks. This is a statement of retained earnings. You have beginning balance retained earnings. Then you have plus your net income minus any dividends paid out equals a change in retained earnings, giving you ending balance retained, beginning balance retained earnings minus ending balance retained, or I'm sorry, plus retained change in retained earnings equals retained earnings. Sometimes this could be negative. And the way it'll be negative is if there was a negative net income for that year. Hopefully that doesn't happen. You don't want negative net income for a year. That's not good. That means you're losing really bad. As you know, through adjusting entries, what you learned about adjusting entries in 220, hopefully. And as you learned about adjusting entries, we know that sometimes we need to make corrections. And that is made during the period for prior period adjustment. When there's an on the statement of stockholders' equity, you'll also see, in addition to the retained earnings, you see paid-in capital. Paid-in capital shows up under the statement of stockholders' equity when there's a difference between the issuance of stock or purchase of stock and the stock itself. So that's when you'll see that paid-in capital amount. So here's another example of statement of stockholders' equity. Beginning balance plus net income minus dividends, and sometimes plus or minus the issuance of additional common stock, plus or minus purchase of treasury stock equals ending balance. So we can see that additional paid-in capital shows up in our total. So preferred stock plus common stock plus additional paid-in capital plus retained earnings minus treasury stock, giving us our total for the balance, and then going through the transactions throughout the year. So when you look at your 10K reports, you'll see something like this for your company. And when you see additional paid-in capital, we know that there was either a premium or discount paid on the stock. Here's an example. This example is for Alphabet Company. You probably know them as Google. For Google, also the parent company is Alphabet. Here's an example of their stockholders' equity from a long time ago. This from 2016. We see Class A, B, and C of common stock at 0.001% par value. We see additional paid-in capital, accumulated comprehensive loss, retained earnings, and the total stockholders' equity. This is from their balance sheet, and it just kind of shows you how everything's listed out. If this is the expanded version of that, so we can see in comparison how everything played out from the beginning of the year to the end of the year. A couple of formulas I want you to know and to use, right? Earnings per share. Earnings per share, very commonly used calculation to understand how much the company has earned per share outstanding or per share issue. And this calculation helps the company to understand the value of each share. How do we calculate earnings per share? We take net income minus preferred dividends divided by the average number of common shares outstanding. How do we find the average of anything? Beginning of the year plus the end of the year divided by 2 to find the average. Beginning of the year plus the end of the year divided by 2, find the average. So recent year prior data, net income, average number outstanding gets you earnings per share. And of course, you do that preferred stock and common stock. It works the same way. Dividends per share. This one, definitely know this one. You'll see this again. Dividends per share. What this does is it helps common shareholders to understand the amount that they would receive if the company declares a dividend. Dividends on common stock divided by shares of common stock outstanding. Dividends on common stock divided by shares of common stock outstanding gives you the dividend per share common stock. Of course, you could run out the same for anything else. And this is just a nice graphical representation for comparisons of year to year for dividends and earnings. Last but not least, these last 2 slides. What I've done for you here is I'm providing you a cheat sheet of the formulas. These formulas, as you know, are designed to measure the company's success rate, in my opinion. Liquidity, as you know, liquidity represents the company's ability to be liquid, to raise capital, to use capital. Liquidity. There's a bunch of formula that we use. Some of these you probably remember from 220. Some of these you might not, or maybe you haven't seen them, but all of these are very effective methods of measuring liquidity. Solvency. Solvency represents the company's ability to pay all of its liabilities, right? That's solvency. Assets minus your liabilities is solvency, essentially. And there's a couple of ratios that we can run out to measure solvency. And last but not least, but probably the most important, is profitability. The company's ability to be profitable can be measured through several different computations. And these computations help investors to understand if the company is profitable or not. And so these are the types of ratios that we can compute to understand company's profitability. And that, my friends, is the conclusion of today's session. I apologize for going a little bit over, but again, very important concepts to explore. The slides, if you're looking for copies of the slideshow presentation, if you go into the classroom and go under discussions, activities and assessments, discussions, and it'll be right under Ask the Professor, week 1 Zoom. I'll post the recording when it's done, and you can download the PowerPoint presentation from there. Are there any comments, questions, concerns? Ashley, Michelle, iPhone. Whose iPhone? Who's that?
I don't know. So I think I'm pretty good. That was really helpful. I'll definitely be referring back to some of those. So thank you.
Awesome. My pleasure. Yeah. And again, if you ever have any questions, just feel free to shoot me an email, you direct message me, whatever. Be happy to help you out.
Great. Well, it's nice meeting you.
Yeah. Nice meeting you as well.
I was going to say,
thank you so much. I'm sorry, Michelle.
I'm sorry. I was just going to say I enjoyed it as well. Thank you so much. This was helpful. I didn't even realize that we were going to get the opportunity to have you explain this. So I'm glad that we have these recordings. It'll help a lot, especially for me. I'm usually more on the the income statement side. And so the balance sheet, anything below the balance sheet is not something that's my forte. For us to just dig right into this is like, wow, first day. So
yeah,
thank
it's
you.
a lot. Yeah, it's a lot on the first day. But yeah, so Michelle, my recommendation is to definitely explore as much of the concepts as you can about the balance sheet, especially because this course is, we call this managerial accounting. That's the other term for principles too, is managerial accounting. We focus mostly on the balance sheet and how to manage effectively from the balance sheet. We'll look a little bit at the income statement, of course, because as you know, the income statement drives the balance sheet. But how do we manage the business? We manage it primarily from the balance sheet. And we're going to dive real deep into a lot of balance sheet concepts. So just take your time with it, and slow digestion of the concepts, but definitely read through. My recommendation, a little bit each night. Go through the concepts, and you'll be okay. It's a lot of information, I know, but
it's exciting. It's exciting, and this
yeah.
is where I need to be. If I know the one side, now it's time for me to grow up, so to speak.
Exactly.
It's exciting.
It helps, and it'll help you with your business, and it'll help you with your, management style, and it'll give you a lot of really good insight. So awesome. Well, thank you so much. I appreciate all of your time. I hope that these sessions will be helpful. Again, I'm here for you anytime you need me. Feel free to call, email, call, set up office hours, whatever you like. I'm here for you. So thank you all so much. Enjoy the rest of your morning, day, evening, night, wherever you may be. And I will see you all again next time. We'll meet again. Hopefully the goal is to try to meet every Wednesday. Except for, of course, the final week, because there's not going to be any new content in week 8. But again, I'm looking forward to a wonderful semester. Looking forward to meeting you all and talking to you all in discussion forums. So thank you all so much. Appreciate you. Enjoy the rest of your time. Thank you so much. Bye-bye.